Okay, guys, so welcome to today's class. This year is going to cover valuations. So the structure of today's class is as follows. We're going to spend about 30 to 45 minutes on an overview on valuations and the different types of valuations and how to set up the calculation. Then we will cover a quick question from the 2021 test 2 test. Okay. So in the 2021 test 2 test, I covered the dividend growth model. I have already covered the free cash flow model. I've already covered the PE multiple. So by covering the dividend growth model, then we cover all three major valuation models. So I'm only going to cover the dividend growth model by going through the question, but I'm going to go through each valuation model in terms of showing you how to set it up, what to look out for, what are the key principles, and those type of things. What's very important when it comes to valuations is that on a cycle level, right? If you must, for example, write the ITC exam, and this is very much true for WACC calculation. It's very much true for capital budgeting calculation, and it's very, very, very true for valuations question. And the same thing apply in financial reporting as well, but they tend to do it quite often in financial management. What do? They give you the calculation and then they tell you to identify or to critically evaluate the calculation, meaning you need to identify any errors and you need to identify any omissions, and then you need to show what is the correct treatment. So that is extremely, extremely important. So when I go through the various types of valuations, I will explain to you the key issues that you need to be aware of. So like I said, it's very important to know how to calculate, but it is equally important to be able to evaluate a calculation that is given to you. So just be aware of that. Okay, very, very important. They do it a lot in financial management. They also do it in financial reporting. So be aware, when you get something, always ask yourself, will you be able to identify any error? Can you critically evaluate a calculation to spot the error, to spot omissions? And so remember, error and omission is similar, but it's different as well. An error is something is in there, but it's wrong. An omission is something supposed to be there, but it's not there. Okay, so you must be able to identify errors and omissions and then provide the correct treatment. Okay, so now we're going to jump straight into valuations. And then we will cover the question afterwards. So I'm just going to switch over into Google Sheets quickly. So what you need to know that valuations is a big topic within financial management. You get tested on quite often, and more importantly, the principles that you learn in valuation is quite pervasive. It gets applied in many, many places. And I think that is why valuation is so important, because critical financial management principles are learned when working through a valuation. Okay. So that is the importance of it. Also, how do you use it in the real world? In the real world, valuations get used in, so for example, in financial reporting, it gets used when you, how can I say now? So for example, you're a financial accountant and you have an asset that needs to be impaired or a business unit that needs to be impaired. So one of the calculations you have to perform is the recoverable amounts. The recoverable amount is one of two amounts. It is fair value less cost to sell, or value in use. Now, when you determine value in use, you use valuation principles. You use a particular valuation, and you must to determine the value in use. And that's very important for financial reporting purposes. Like every single year, one of the companies, the head of finance, and sometimes actually the finance directors who perform those calculations, and the auditors audit it. And what auditors used to do, they get their corporate finance specialists to kind of work through it and then give them an opinion on it, and then they would decide whether it's reasonable or not. So in financial reporting, very, very important. When you come to, from a normal business perspective, so there you can see I was using financial reporting. From a business perspective, when you want to do a merger and acquisition, you will value a particular company to decide whether, or to decide what amount you are willing to pay for for another company. Also, I don't know if you follow the news, but recently there's been a big there's been many companies that wants to, what they call it, do unbundling. Why do they want to do unbundling? It's because the value of, so for example, who was it now? Yeah, so for example, you have PSG, I think it's called, yeah, PSG, or whatever it was, I think, yeah, PSG, whatever the companies was now, I can't remember, I think it's called PSG. They were the holding company that is listed on the JSE, right? So I'm just gonna make up numbers, I can't remember the numbers. So let's say on the JSE, that holding company's shares is trading at, let's say, 100 Rand per share. Now, the holding company is holding Capitec. It is holding other big companies as well. I cannot remember the names. I know Capitec was one, and there was like another one or two others, right? Now, I think it was PSG Asset Management they were holding, and there was also something else. Now, the holding company, which owns all of those other companies, underlying companies, that shares was trading 100 Rand. But when you look at the value of each of the companies, then if you must add up the value of each of the companies separately, it came to, let's say, 1,000 Rand per share. So companies did unbundling in order to, they use the term unlock value, because while all three of those major companies is sitting in one holding company, that holding company shares is only trading at 100 Rand, and they try to move different types of ways in order to increase the value to get it to 1,000, but they can't get there. So then what do? They call something unbundling in order to unlock value. Unlock value means there's a missing 900 Rand somewhere. So the way they're going to achieve that 900 Rand is by getting rid of Capitec. So PSG Holdings no longer hold Capitec. Capitec is listed on its own. PSG no longer holds PSG Asset Management. PSG Asset Management, for example, is listed on its own, or they take it completely private or something of that nature. So in the real world, these are serious things. So in order to know whether your shares are properly valued or not, you need to know various valuation methods. And obviously, maybe the CEO don't know the details of the valuations, but they have people like the accountants or other corporate finance specialists to actually do the valuations, to provide them with what the true value or what the estimated value is, and they compare it to what's trading in the market. So valuation is extremely important from a real world perspective, and is extremely important from a MAC and a psycho point of view. Psycho likes to test valuations. They don't always test it, but when they do test it, they test it really nicely, meaning it's not easy. So so make sure you are able to perform a valuation, meaning do the calculation and understand why you're doing what you are doing, and be able to critically evaluate a valuation that is given to you. So that is a nutshell why it's important and the real world scenarios. Now we come to the types of valuations that we need to know. Now, there are various valuation methods, models, whatever you want to call it, right? So we basically need to know the following, in no particular order, but basically we need to know the free cash flow method. We need to know the dividend growth, or the Gordon growth model. We need to know, so remember, we need to know an earnings multiple. There are various types of earnings multiples, various types of earnings multiples. But the one that we use mainly is the PE multiple. Okay, so just take note of that. So we the valuation is a earnings multiple. There's different types of multiples. So the earnings multiple that we use is the PE multiple, or earnings yield. Okay, earnings yield. So what you might just make sure, what do they ask you for? Do they ask you for the PE multiple, or do they ask you for the earnings yield? Okay, what you might just know, the one is the inverse of the other. So if you can do a PE multiple, then you should be able to do an earnings yield. So there's no need to study the two separately. You simply learn the one, and then immediately for 5 minutes, you just ask yourself, what if I had to do it from the earnings yield perspective? How would I do the following? So everything will be the same, but the direction would be different. So what you might just know, the PE multiple is equal to 1 divided by the earnings yield. Very important. If they don't tell you to start with the earnings yield, you always start with the PE multiple. It's much simpler for our brain to work through. But if they give you the earnings yield and they don't tell you you must use the earnings yield, then convert the earnings yield into a PE multiple. How do you convert the earnings yield into a PE multiple? You just say 1 divided by the earnings yield, and that will give you the PE multiple. That is why if you can do the one, you should be able to do the other. Just the directions would be different. Okay, so these are the main methods of valuations. These are the ones that's going to draw the 10, 15, 20 marks. Okay, so these methods is going to draw the 10, 15, 20 marks, 25, 30 marks in valuation. The free cash flow can easily draw you 30 marks. Dividend growth model from 10 marks upwards. PE multiple generally about 12, 15, 20 marks, depending how complicated it is. Okay. Then we have other smaller valuation models that you must be able to do. What you must know, these are not going to be done. These are done as not as a main valuation method, but rather what they call it as a reasonability check. Obviously, they tell you to use it as your main valuation model, then you do it. But in reality, if you, let's say they give it to you and they ask you to critically evaluate, then you must tell them that these valuation methods is not should not be used as your primary valuation, but rather should only be used as a reasonability check. So what are the others? So the other one is net asset value. Okay, so net asset value. Net asset value is simply net asset value is simply equity, okay, per the balance sheet. Okay, so net asset value is simply equity. Remember, assets equals equity plus liabilities. Assets equals equity plus liabilities. Assets equals equity plus liabilities. That's the accounting equation. That is the balance sheet. Okay, so if you have a look over here, this is the assets section of the balance sheet. That is the equity and liability section of the balance sheet. Okay, so assets equals equity plus liabilities. Net assets, the word, so there you can see it is net asset. You can see the word asset is there. You can also see the word net. So the word net implies something has been subtracted from assets. So what have been subtracted from assets? Assets minus, so liabilities have been subtracted from assets, and that equals equity. So net asset, it's simply assets minus liabilities, or it is equity. It's the same thing, but depending what they give you, you start from whichever angle they give it to you. So net asset value simply equity or assets minus liabilities per the balance sheet. The only difference from a valuation point of view, valuation is always forward-looking. Valuation is always on a market value basis. So we will start off with assets minus liabilities, or we'll start off with equity per the balance sheet, but then we need to make adjustments in order to take it to market value. Because remember, the balance sheet is carrying amount. We don't want carrying amounts. We don't want book value. We want market value. So in order to get it to market value, you need to make market value adjustments. Okay. So just be aware of that. And then we have market capitalization. Market capitalization. Now, market capitalization is not really a valuation method. Market capitalization not really a valuation method, because what is market capitalization? Market capitalization is the method we use in WACC. It is just basically value equals number of shares in issue times share price. Now, why this is not a true valuation? Because what a valuation is trying to do is to use the numbers of the company, is to use the business numbers and try to come up with what the company is worth. Where the market capitalization method is using the share price. The share price is not necessarily what the business is really worth. It is just basically what the market thinks the company is worth. Sometimes the market is right, and sometimes they are completely wrong. They're completely wrong by either being too optimistic and the price is very high, or they're either wrong by being too pessimistic and the price is completely low. So that is why there's not a true valuation, but it is a quick reasonability check. Similarly over here, not a true valuation, this is simply using accounting numbers. Accounting numbers is not necessarily a representative of what valuations is all about. Valuations is trying to value the cash flows, the underlying stuff of the business. So this is also just used for a reasonability check. A reasonability check is just by saying, you got a number for the free cash flow method. If I use market cap, or if I use net asset value, what does the valuation come to? And then what asset managers like equity analysts and all of those guys, when they use one of these methods, to value as a primary method. Then they use this to do a comparison or a reasonability check. The difference, they will call it, I cannot remember what they call it. They call it a upside or a downside, something like that they call it. So if the free cash flow is higher than the NAV or the market cap, they call it an upside, and they have a percent. They calculate a percentage of what the upside is or what the downside is. Something I can't remember the terminology. I remember my wife does these stuff, so I can't remember what's it called now. So I think it's called an upside or a downside. Right? They have actually a term for that difference between the actual valuation that they performed relative to the NAV or to the market cap. So once again, from a technical point of view, not true valuations. We only use them as a reasonability check. Then a true valuation, but we hardly use it because it hardly gets used in the real world, but it's actually a very good valuation method. And I'm not really exactly sure now if it's still examinable from a psycho point of view. I think from a psycho point of view, you need to be aware of it, but I don't think you need to be able to perform the valuation. And that is the economic value added method, I think. So it's EVA method. So the EVA, technically speaking, the EVA and the free cash flow will basically is kind of like the same thing. Okay. Somehow you can use the EVA and get to the free cash flow model, but that's highly technical. Okay. So I kind of remember how to do it. Like what I did was So I enjoy financial management. So like I was studying one of the textbooks from McKinsey, and they take you through the whole process of valuing a company. So it's quite deep, quite good. Like when I used to like before I go sleep, I used to spend like an hour every night and read that textbook. It's quite like 1,000 pages or something. So it was quite what you call it. So I learned quite a bit on how the things work over there. But what I do know is somehow you can take the economic value added method and come up with a free cash flow model. But like I said, we don't exactly need it. We don't exactly need to know it. You need to know how it works and all of those type of stuff. You need to be aware of it, but I don't think it is like on the level that you need to be able to perform it like you need to be able to perform those three evaluation methods. So as you can see, that is 1, that is 2, that is 3/4, 5, 6. There are 7 methods. So the top 3, or I mean, you can call it 4 as well, with earnings yield, you must know inside out. You must be able to do this one. This one is super easy, and you might just be aware of the economic value added method. Okay, I don't think it's as important for us, but the world is moving closer to using that. So you can learn it if you want to, but make sure you definitely know the top 3. Now I'm gonna go through the various valuation models of the top 3 only, and show you how to set it up and what are the key issues. And then we're going to go on into doing the example for dividend growth model. The free cash flow and the PE multi, I'm not going to do because I've done it before. Okay. So I'm going to start off with the PE multiple. Okay, just so you know also what's important to take note for these 3 over here. You must be able to know when to use which valuation model or method. So if they don't tell you which method, this is typically true when you have to critically evaluate, or you need to provide, you need to explain to someone whatever about valuations, then you need to be able to tell them which valuation method you are using. So like I said, like with an analyst, on when they prepare a report for the portfolio manager and all of those type of stuff, the first page is a quick summary of the important details. One of the important details on the first page quick summary is the valuation method that they have used, and they need to explain why. So it's very important to know why you're using a particular valuation method or model. So typically, you will use a free cash flow if you are so from a technical point of view, this doesn't happen exactly in the real world, but from a technical point of view, you use a free cash flow model when you have to value a majority interest. That is why when you read a scenario and you're looking what percentage you're acquiring, that must indicate to you what is the majority interest or minority interest. So when you're acquiring more than 50%, that is considered a majority interest. So when you are valuing a majority interest, when you use a free cash flow model, or you want to use an earnings yield model, and I'll explain why. So if you understand, the free cash flow model is valuing the operations of the business, okay? And from there, they get to the value of equity. So the free cash flow model is valuing the operations of the business. And then from there, you maneuver to get to the value of equity. Now, if you have a majority interest, it means you can control the operating policies of a business. So as a result, you are able to affect um, how much money how much profit the operations can generate, how much cash flow the operations can generate. So therefore, it makes sense that you use the free cash flow, because once you control, you can make all those important decisions. So you can impact revenue, you can impact cost, and as a result, you can impact cash flow and profits. So that is why that makes sense. Similarly, over here, the earnings multiple. We will generally use the earnings multiple also when you have a majority interest, and you particularly use it also when you valuing a private company. So that is one of the reasons over there. And part of the reason why you use the earnings multiple, because you hardly have detailed financial statements from if you have a private company. So as a result, you kind of use basic financial information that you may obtain and try to maneuver that. And the reason why you also use this for majority interest is that you are impacting earnings, you're impacting profit. Remember, the earnings, the PE multiple says value equals PE multiple times sustainable earnings. So you can impact sustainable earnings when you have a majority interest. And as a result, it makes sense for you to use one of these methods for a majority interest. You will typically use the dividend growth model for a minority interest. Why? As a minority interest, you cannot impact the profit level. You cannot impact the cash flow level. All you are getting as a minority investor is a dividend. So as a result, you want to value the business from that perspective. What is your benefit from investing in the company as a minority interest? It is only the dividend. Well, and obviously capital gains, but from a cash flow point of view, it will be the dividends. So therefore, the dividend growth model would be the more appropriate. Now, the assumption is in like in the real world that all value, all when you're valuing a company, especially from a like if you read the CFA notes will tell you that you'll generally use a dividend growth model always, because when an asset manager invests in a company, they're not really buying a majority interest. They are buying minority interest. So that is why they will always value it from a minority interest point of view. And that is why most companies will use a dividend growth model. Also to take note, the dividend growth model is also only applicable if the company has a history of dividends. And like CFA says, even if you read the CFA notes, they will tell you that a proper history of dividends is a consecutive dividend payment, a predictable consecutive dividend payment for a period of at least 10 years. Ideally 15 years. So if a company has declared dividends for at least the past 10 years, and when you work out the dividend payment, you can pick up a dividend policy, then only can you also use the dividend growth model. Because if there's no consistent dividend payment, then your valuation will not be appropriate, because you assuming that you're going to be getting a dividend every year, but history is not showing that there was a dividend every year. So then you can't also use the dividend growth model. So that is important stuff to take note when to use a valuation method. Okay, so just take note of that. So let's go on. Let's start off with the PE multiple. So the PE multiple, so when do we use this? When you have a majority stake, when you want to acquire a majority stake, and most likely you also use it for when you have a private company. I cannot remember what's the reason why we use a PE multiple, why they typically use a PE multiple for a private company. But if my memory serves me correct, I think it's because you don't necessarily have the proper information. Remember, with a listed company, you can see all the details in their financial statements, because you can Google it basically, because they have to make it public. With a private company, you don't necessarily have all of that information. So you might get basic information from them, okay? And then as a result of that, you'll be able to somehow maneuver certain, you will somehow be able to maneuver a valuation out of that. So you won't have detailed information in order to prepare free cash flow. But if you do have a detailed information, then you can use the free cash flow. But it just so happens that typically when you want to acquire a private company, they generally use the PE multiple. Okay, so remember, the objective of all of these is to value equity. Okay, so let me just actually make that clear. The objective of all of this is to valuation methods or models to value ordinary equity. So we're not valuing debt, we're not valuing preference shares, we are valuing ordinary equity. So ultimately, we want to come to a value of equity, either a total value of equity or a value of equity per share. Very important to pick that up in a scenario, whether you want total equity or whether you want equity per share, okay? So what are we valuing? We are valuing equity. So it's going to be value of equity equals, it's going to come to PE multiple times sustainable earnings. Sustainable earnings. Now, it's either you call it sustainable earnings or you call it maintainable earnings, doesn't matter. So that is the general formula, right? But here are some important things. The way you want to set it up, you will look at it as follows. You will just set up PE, then you will set up sustainable earnings, and that will give you value before. So just give me a moment. Just give me 2 minutes. My kids just broke in again. And I'm back. So that is value before adjustments. Okay. So what adjustments do we have over here? So the typical adjustments that you're going to have over here would be a majority premium, or the typical adjustment we'll have would be a marketability adjustment. So this is a negative adjustment. And we have again value after marketability adjustment. I'll explain all of this now. This is just basically the setup. Then you're going to have a majority premium. And then a majority premium means you're going to add a premium, and then you will just get value of equity. Okay. And this here is 100%. The reason why I put there 100% because the value is always going to be for 100%. Then if you want it on a per share level basis, you need to divide it by the number of shares in issue, or if you want the percentage you want to acquire. So let's say you want to acquire 60%. So they may say, dear student, please determine the value of 60%. So when we stop over here, this is not the answer, but that is the value of 100%. So to get the value of 60%, we simply just multiply by 60%. So just take note of that. Or if they ask you to get the value per share, you're always going to get to this point. But then to get to a value per share, we divide by the number of shares in issue. So just be aware of that. Now, this is always what's going to happen. So as you can see, you're going to need PE, you're going to need sustainable earnings, you're going to need the marketability adjustment, you're going to need the majority premium, and that will give you the answer. Okay. So let's now go through all of those line items. So remember, when do we 2 minutes. So so when you have a so take note, we use the PE evaluation when we typically going to use it for when you're acquiring a majority interest, and or if it's a private company. Okay, so typically that's going to happen. So to work out the PE, to work out the PE multiple, what's going to happen is the following. To work out the PE multiple, we're going to have a working. Okay, so the PE multiple is going. This is going to be the starting point is going to be as follows. Start with PE of comparable company. I don't know how to spell this. Comparable. I think it's something like that. Okay, comparable company. So let's just say 12. Okay. So they will give you the PE of a comparable company. So why a comparable company? What is PE? PE is price earnings. So price earnings is share price divided by earnings per share. So in order to have a PE ratio, you need a share price. Now, because you're a listed company, you won't have a share price that is in the market. You may have a share price, but you will only know it because you may have done a private valuation as the management of the private company, but someone outside won't know that share price. So therefore, when we use the PE valuation and we are valuing a private company, we will start off with the PE multiple of a comparable company. So that is what they will give you. They'll give you the PE multiple of a comparable company. Now, what's very important, they may give you more than one PE of comparable companies. So the question is, which one do you use, or how do you get to the which PE number do you use? So let's say they give you 3 PE multiples. What you could do, you could add up the 3 and divide it by 3 to get an average, or they may give you a weighting for each one and you get a weighted average of the 3 PE multiples. So that's an option. So option number 1, you take the 3 PEs, you add them together, divided by 3 companies to get an average. Or you take the PE, they maybe gave you a weighting of how much does each PE weigh to get to 100%, and then you add them up to get a weighted PE. That's option number 2. A third option, which is very important to take note, that you may only need to choose 1 or 2 out of the 3. So remember, it does not mean that they give you 3 PE multiples that you must use all 3. When you read the brief story about the company, you need to identify which of the companies are most comparable relative to your company. So you either choose the most comparable one or the ones that are comparable with your company. So that's very, very important to take note. Don't simply take the average of the 3. Don't simply take a weighting of the 3. You need to ask yourself, is all 3 of these companies comparable, or it's only one, or it's only two. If all three is compatible, you choose all three. If then you do average. But if only one is compatible, then you choose the compatible the company. So just take note of that. Okay. You'll be lucky they just give you one, and that's typically what happens. But there are times when they give you more than one PE of different companies, and then you need to make a selection. When you make the selection, don't just make a selection. You have to make the selection. That's number one. The second step is to tell them why you did what you did. You need to provide them with reasoning. Okay. So we start off with a compatible company. But we don't want the PE of a compatible company. We want the PE of our company. So we start off with a compatible company PE, and we make adjustments. To get to an adjusted PE, which is a representative of a PE for our company. So what do we want to get to? We want to get to this number. We want to get to an adjusted PE. You want to get to an adjusted PE multiple, which is the representative of a PE multiple for our company. So what do we adjust for? We adjust for between comparable and target company. That's very, very important. Our company is the target company, the company that is being acquired. That is the target company. Okay, so you adjust for differences between the comparable company and the target company. Why this is important? Because they may give you information that is general, meaning it is information that applies to everybody, all companies in that industry. So the fact that some event impacts every company in the industry, you can't have it as an adjustment over here, because it's not a difference between the comparable and us. It is impacting every company. So that's very important to take note. Okay, so you start off with a comparable company and you make adjustments for differences between the comparable company and us. Okay, you don't adjust for something that impacts everybody in the economy, everybody in the industry. Okay, so just take note of that. So what are examples of adjustments? So typically, you must make adjustments to a PE multiple for differences between us and the comparable company that cannot be taken into account in when adjusting earnings. So that's very important. You don't want to make an adjustment over here and make the same adjustment when you adjust earnings, because then you'll be double counting the adjustment. So just take note, they look out for those kind of stuff, whether you double adjust. If you do double adjust, they're going to penalize you, okay? Because it's clear that you're not understanding, or you're missing critical, that you're missing a fundamental issue. So make sure when you make adjustments that you don't double adjust, meaning that same adjustment must not be in the PE and in the sustainable earnings calculation. So if you adjust it in the PE, don't adjust it in the sustainable earnings. So typically, what would you adjust for in the PE multiple? Examples would be growth, management, capital structure. Okay, so these are typical things that you'd adjust for. So for growth, for expertise, leadership, another, I just had it on my mind, I just slipped my mind. Market share, Another one, I was trying to get to the thing. Product differentiation. I don't know how to call it now. There's a term I want to use. I just can't call it now. But I'll just say types of products. Okay. So for example, let's say the comparable company is a company is a cosmetic company, just like call it like that, right? Now this cosmetic company sells stuff for face, for body, for eyes, for lips, for I don't know what else you get for cosmetic, for nails and all of those type of stuff, okay? Hair and everything. Let's just say they do that. So, but your company only do hair. So as you can see, your company have less of a variety or less markets relative to the other company. So that is typically a negative aspect, okay? So that is typically a negative aspect because the other company is in more markets relative to you, so their growth potential is better. So that is a negative thing. So what you do to yours, if you have less products relative to them, you'll just say a minus, okay? So I'm just gonna do that. Okay, market share, if your company has a bigger market share in something or a smaller market share, so if your company is better, you will have a plus. If your company is worse off, you will have a minus, okay? So just take note of that. So you put a plus if your company is better, you put a minus if the other company is better, okay? Expertise leadership. So let's just say in the particular field you are busy with, your management team is top notch, okay? You have the leadership in that aspect, then you will put a positive. But if the other company is better off than you'll put a negative for you. Capital structure is just got to do with because you're a private company, the other company is a listed company. So most likely the listed company will have more debt than you will have less debt, or you will have no debt. So as a result, you're probably less risky. So that means it will be, you are better off. Also, the fact that you have no debt. So if we must buy you, that means we have the potential because you have no debt and we buying you. That means once we buy you, because you have no debt, banks will offer us debt because there's no risk to them because you have no debt. So that is a positive. So then we'll put a positive. Okay. Then with senior management, if someone left your company, that's a negative thing. But if you have top management, then it'll be a positive thing. Okay. Similarly with growth, perhaps you are a smaller company or something of that nature. So you have a greater growth potential, or you're more innovative. So you have a greater growth potential. So that will be a positive. But if you have less growth potential, it will be a negative. So you're simply putting a positive or negative. If you are better off, then you put, if you, the target company, is better off relative to the comparable company, you put a positive. If you are worse off relative to the comparable company, then you put a negative. Okay, that is simply what you're going to do. These are just examples of what you're going to look out for. Okay, these are simply things that you're going to look out for. Okay, so you look for anything that talks about that. Okay, they're not necessarily going to use those terminology, but you must look for stuff that speaks to those type of items. Just look for about 3 to 5. You don't have to write the whole world down. You just have to look for 3 to 5. Okay, then you just have a look at your list. You see if you have more positives or more negatives. If you have more positives, you will have a bigger number than that. If you have more negatives, you'll have a smaller number than that. Typically, it's going to be smaller. You make it up, okay? I just say always go with 2 to 3, okay? So if you have more, then you add 2 to 3. If you have less, you add 2 to 3. I mean, you subtract 2 to 3. It's typically going to be less. So let's say we're going to subtract 2. So then I get to a PE of 10. Simply thumb thucking. What you're getting marks for is the things you're listing over here, whether it's appropriate, then whether the direction is correct. That's why they don't put a number. They want to see the direction. So if you're getting the direction correct, then you will get the mark. If you get the direction incorrect, you won't get the mark. Just take note, if you are getting the direction consistently incorrect, you're not just going to get it wrong, they're going to subtract marks. Okay, just be aware of that. If you get the direction consistently incorrect, meaning what should be positive is negative and what should be negative is positive, you're doing that consistently, then that tells them you're totally confused, you don't know what's happening, so then they'll penalize you for it. Okay, so you don't just get it wrong, you also get subtracted marks. So what's important is the direction. If the direction is correct and what you're writing here is correct, then you will get the mark. So just do 3 to 5. Don't do more than that. Then from there, you can see whether you have more positives or more negatives, and then you will have a number. If you have more negatives, you subtract. If you have more positives, you add. Just add 2 to 3 or subtract 2 to 3. And there we have adjusted PE. You could plug that in over there. Now we come to sustainable earnings. When you have sustainable earnings, what's going to happen? You'll get a number of years of earnings. Okay, so we'll get a number of years of earnings. So we'll have, okay, okay. So calculating sustainable earnings. Okay, so what will just happen? You will have the earnings numbers. So you will start off with earnings. Okay, you will have, let's just say the number of years, 2021, 2020, 2019, 2018. So you will have the numbers over here. Then you need to adjust for irregular items. Okay, irregular once-off items. Okay, so what is going to happen over here? Typically, examples would be there was a once-off revenue contract, or there was a once-off major cost, or there's a once-off major impairment, or there was a manager resigned, so there's a restraint of trade package that you had to pay, something of that nature. So something where included in this earnings number, it is not a regular thing. It doesn't happen every single year. It only happened in that particular year. Okay. Strictly speaking, you also need to adjust for future items. So, for example, these revenue items could have included a 5-year contract. But in 2021, that 5-year contract came to an end. So basically from 2022, there's no longer a 5-year contract, so you kind of need to remove the contract. That because going forward, because in future, remember valuation is always forward looking. So in future, that the revenue is we're not going to receive that revenue. So we actually need to take that revenue out because we want to work out a sustainable earnings figure going forward. So because the revenue is no longer going to take place in future, we need to remove it from the current earnings to get the future amount. So that is technically what needs to happen. But they hardly give those kind of scenarios. What just happens is they'll tell you got a once-off grant, or you had a once-off contract, or something of that nature. So if something is sitting in an earnings figure and is no longer going to happen going forward, you need to adjust for it. So typical examples: once-off revenue contract, or end of a revenue contract, or restraint of trade, or a once-off grant. Okay, so government or foreign grants. Okay, or once off irregular write down. Okay, so that is an example. Okay, irregular timing difference. Okay, so for example, like in case in India, there's the flood, right? So that is a once, so it's not going to happen all the time, or we don't expect it to happen all the time. So with the floods, there was major write-downs, impairments, and all of those type of stuff. That's not going to happen every single year. So as a result, we'd have to adjust for that item, okay? Because they don't expect it to happen every single year. Similarly, irregular timing difference. So let's say as a result of the floods, a sale will have happened this year, but because of the floods, there was road closures. There was no aeroplanes coming in, no ships coming in, all of those type of stuff. Trucks couldn't drive and all of those type of things. So as a result, the sale did not take place this year. It can only take place next year. So what would you do? Because the sale, if it wasn't for that once-off event, the sale would have taken place in the current year. So you make and it would not have happened in the next year. So then you adjust the current year figures to take into account that the revenue that should have been recognized, it would have to account that it would have been recognized. So what you're doing with sustainable earnings, you want a earnings figure that is maintainable, an earnings figure that is sustainable, meaning if normal operations must happen, what would the earnings figure have been without the irregular item, without the once-off items, and you get a figure. So now this will give you a sustainable earnings figure. Okay, so this will give you a sustainable earnings. Okay, so now you will get a number. Now, once you have the number, you need to decide which number you're going to use. So how do you know which number to use? You're going to have to look at the pattern of these numbers. If the pattern is consistent, meaning it's going in one direction, it's either increasing or it is consistently decreasing. So there's a pattern. Every single year it was decreasing, or every single year it was increasing. So there is a pattern, there's a trend that is actually happening. So as a result, what you do, you will use the latest number. So you'll use 2021. However, if there's no pattern, it is irregular. 1 year increase, next year decrease, then it increase, or it decrease, increase, decrease, or it decrease, increase. So the pattern is irregular. So if the pattern is irregular, it's not a consistent trend. A consistent trend means it is going in one direction, either increasing or it is either decreasing. If there's a consistent trend, you use the latest number. If there's no consistent trend, then you must use a weighting of these numbers. How do you do a weighting? You give the the way you're going to weight it is as follows. Okay, so the weight would be as follows. You start off with number one. Number one will start with the first year. So you just say 1, 2, 3, 4. Okay. So take note of what you're doing. We only use a weighting if the pattern is irregular. If the pattern is consistent, you use the latest year. But if the pattern is irregular, you use a weighting. You don't simply take an average, you use a weighting. How do you use a weighting? You start with year 1, you say 1, and you just go all the way 2, 3 till the last thing. In this case, it's 4. So if we add this up, you can see it is 10. So what we do, the weighting would be as follows. That is going to be 4 divided by 10. And then If we do that, it's going to be like that. So if you add it up, it's going to come to 1, if you want it to be. So then the weighted average would be as follows. The weighted average would be as follows. They just make up a number. I'm just going to make up numbers now. 10,000, 8,000, 9,000, 7,000. So there you can see it's irregular. So the weighting would be as follows. It's going to be 10,000 times that weighting. It's going to be 8,000 times that weighting and so forth. So when we add up, the sustainable earnings figure would be 8,900 Rand. So when do you use this method? When the pattern is irregular. Here you can see it's 7,000, then it went up to 9,000, then it went down to 8,000, then it went up to 10,000. So as you can see, it's an irregular pattern. There's no consistent pattern. So then you use a weighting. The latest year, get the highest weighting. Okay, so how do you do it? You just simply start with year 1, and you say 1, 2, 3, 4, add it up, you get 10, whatever you get. Okay. Then you say 4 divided by 10, 3 divided by 10, 2, whatever you get each weighting, it should add up to 1. And then you say sustainable earnings times the weighting to give you these numbers. So if you add up the weighted average, it will be 8,900. If you add up that average, it is some different number. I don't know what it will be, but anyway, so it comes to 8,900. Okay, so 8,900, that would be your sustainable earnings. So you take the 8,900 and you plug it in under sustainable earnings over here. Okay, so you'll plug it as sustainable earnings over there. If this was a consistent trend upwards, we'd use the latest year, which is 10,000, then we'll put 10,000 over there. Okay, so just take note of that. So let's just assume we're going to have 10 and we're going to have 8,900. So the value would be 10 times 8,900. So the value is 89,000 Rand. But now, we have a marketability discount. Why do we have a marketability discount? Because the comparable company is a listed company, and the target company is a private company. Now, a listed company, it is more marketable, meaning it's easily tradable because it's listed on a exchange like the JSE. Where a private company is not listed, so you can't easily buy and sell the shares. So that is why they say we have a marketability adjustment or marketability discount. So they will tell you what the discount is. If they don't tell you, you use anything what you want to use between 5 to 15%. Okay. If they don't tell you, use anything between 5 to 15%. Okay. So typically you just use 5%. Okay, so let's just say we're going to use 5%. So all we're going to do, we're going to say negative that equal negative that times 5%. Okay, so now we add up, we get a new value. Okay, now if you are buying a majority stake, 50% or more, they will most likely have a majority premium. You only, so it's very difficult to know when to use a majority premium or not. In reality, you'll add a majority premium when when you acquire a more than 50% interest. But I've done a few questions from UNISA already, and even though you're buying a majority interest, they don't always add a majority premium. So that is why I'm not 100% certain when you do or when you don't from a UNISA point of view. But like I say, typically you will when you acquire more than 50%. So so generally, I would just add a majority premium, even though the question don't say. If the question do tell you, you must add. If the question don't tell you, it's either you do or you don't, because they haven't been consistent over the years. I don't know in recent years if they have been consistent, but what I would do, I'd still add a majority premium, and I'll just leave a note to them, and I'll say the majority premium is added because we acquired more than 50%. You may lose the mark, you may not, I don't know. Okay, so that's the only thing I'm not certain about. But like I said, in reality, a majority premium is generally added if you acquire more than 50%. So what would happen? The majority premium is typically, let's say, 15% to 25%. Okay, so you use whatever you want to use if they don't tell you which one. So let's just use 20%. So we'll say that times 20%. So then we add. So therefore, the value of the company, 100% is 101,000 Rand. Now, if you want only 60%, you take that number, multiply by 60%. If you want value per share, we divide by the number of shares to get a value per share. So that is basically how we deal with a PE multiple. Okay. I just want to get my charger. If you have any questions, you can think about any question to ask me. Just give me 2 minutes. I just want to get my charger quickly for the laptop. Okay, so just got in time before the thing crashed. Okay, so there we go. So that is PE multiple. Now I'm going to do very quickly on the free cash flow because I went in detail on the free cash flow in one of the other videos. I'll share it with you guys if you don't have it. But it's in one of the other videos that is actually freely available. I went in detail. So I'm just going to do very quickly on the free cash flow model. So with the free cash flow model, we are valuing the operations of the business. Okay. Remember, ultimately, we want to get to a ultimately we want to get to the value of equity. But keep in mind, we are valuing the operations of a business, and then from there, we are getting to the value of equity. So basically, and typically, the free cash flow model can be used anytime, but technically it will be used when you are valuing a majority interest. Why does it make sense? Because when you have a majority interest, you can control the revenue, the cost, ultimately the profit and cash flows. You can control the capital structure and all of those type of stuff. And as a result, you will be able to, so therefore, it makes sense that you use the free cash flow model as opposed to the dividend growth model, because there you only, the dividend growth model, you're only accounting for dividends, which is very different from accounting using the free cash flow model. Okay, so the free cash flow, basically the value of equity is value of explicit period plus value of terminal value, okay, or continuing value, okay. Okay, plus terminal value or continuing value. So that is basically the value of equity. I mean, when you use the free cash flow. So how do we do it? We will have a details column. We will have a year 0. We'll have a year 1. We'll have a year 2. I'm just going to do 3 years. Okay. The explicit period is this, the 3 years. The terminal value or the continuing value is every period thereafter up until the end of time. Okay, so the explicit period is year 1 to year 3. Remember, it can be any number of years, whatever they tell you. It can be 3 years, 5 years, 7 years, 10 years, whatever it is. But basically, the explicit period is the period where you have actual information for. When I say, I don't use the word actual, where you have information about. Okay, so the explicit period is the period for all the years that you have information about. Okay, or of, whatever you want to call it. Then every other period thereafter will be known as the continuing period, or the terminal value. Okay, so the terminal value will capture everything after the explicit period. The continuing value, the terminal value, will capture everything after the explicit period. What is the explicit period? It is the number of years where you have information of or about. Okay, so typically, technically speaking, you'd want the explicit period to be 10, 15 years, but in reality, you can't really forecast for 10 to 15 years. We can't even forecast 1 year. How do we forecast 10 to 15 years? So that is why in the real world, most asset managers don't use the free cash flow, because they say, although the free cash flow is, from a technical perspective, sound and more appropriate, the problem with the free cash flow is it depends on forecast. So if your forecasting is inaccurate, in effect, your whole valuation is inaccurate. So because there is forecasting by very definition is going to be inaccurate, and there's going to be lots of biases and all of those type of stuff in forecasting, so they steer away from it. Okay, so like we said with forecasting, you want the explicit period to be 10 to 15 years. You want it to be as the number of years that you can actually do forecasting for. And you also need, and then thereafter you will apply the continuing value. So for our purposes, we're going to assume we can only forecast for 3 years. Okay. Now, typically what's going to happen, you're going to start off with a number called profit from operations. Okay, you're going to start off with a number called profit from operation. Okay, so typically we'll start off with profit from operations. However, you need to don't start off with profit from operations. You need to start off with profit before tax. Profit before tax is very different from profit from operations. So you can start off with any profit number. It's much easier to start off with profit from operations. But the reason why you need to start off with profit before tax is because then they can test a lots of principles. Okay, so by starting off with profit before tax, they can test very, very good principles. But in the real world, you will start with profit from operations. You're trying to avoid many adjustments. With starting with this number, there'll be extra adjustments. So in the real world, you want to minimize the number of adjustments you make. So you start off with a number that requires the least amount of adjustments. So that would be profit from operations, and also makes sense because we want to go from profit from operations to cash flow from operations. So it's much easier to start with profit from operations. But like I said, UNISA is going to start with profit before tax in order to, so that you can get to profit, to get to cash flow from operations. Okay, so what we want to get to over here, we want to get to cash flow from operations. That is what we want to get to. Okay, we want to get to that number. Okay, so we want to get to that number, cash flow from operations. The last thing that will be here is tax. Okay, so the last thing over here will be tax. Now, okay, actually won't be the last thing over here. I'll leave that out for now. So there are two types of adjustments you're going to make. There are two types of adjustments you're going to make. Okay, so the two types of adjustments is one, non-cash flow, and two, non-operational. So the question you need to ask yourself is the following. The question you want to ask yourself is, in profit before tax, what item is non-cash flow? In profit before tax, what number, what item or items are not operational? Okay, so what item is not, for which items are non-cash flow and which items are non-operational? That's what you want to ask yourself. So typically, non-cash flow is going to be depreciation. Okay, so non-cash flow is going to be depreciation. Now you must make sure you get your direction correct. Included in profit before tax is depreciation. What did depreciation do to profit before tax? It decreased depreciation. You don't want depreciation to be in there because you want to get to a cash flow number. So therefore, you will have to add depreciation. So when you evaluate when you critically evaluate a free cash flow, the person may have correctly included depreciation, but they may have done the direction incorrectly, or they may have omitted to remove depreciation. So just take note of that. Okay. Because we start with profit before tax, remember how UNISA sets out their income statement? The income statement looks like this: sales, cost of sales, it will give you GP. Then it will have other income, other expenses. Then we will have profit before interest and tax. Then it will have interest. Then it will have profit before tax. Then it will have tax, and then it will be profit after tax or profit for the year. Okay. That is typically how it looks. Now we're starting with that number, profit before tax. So what's included in there is interest. Now you need to ask yourself, that interest over there, interest is cash flow, so we're happy. But you need to ask yourself, is that interest all operational? Or is some of that interest non-operational? So typically that interest number will be made up of two things: interest on overdraft, interest on debt. Now interest on overdraft is typically operational because the overdraft is used for operations. So because the overdraft is used for operations, the interest on the overdraft is operational. If the overdraft is not operational, then the interest on the overdraft will not be operational. Now, definitely, if there's interest on debt, like interest on debentures, interest on long-term loans, that is certainly non-operational because interest on debt, on long-term debt, is a financing decision. So that interest is a financing cost, not an operational cost. So then you must also remove the interest. So you will add interest on debt. Okay, so just take note of that. Okay, then you must have a look at other items as well. So let's say you may have had uh, an investment, um, which is a non-operational investment. So what you do, you maybe sold that investment. So you made a profit or a loss on that investment. That profit or loss is sitting in other expenses. If you made a profit on the investment, because that investment is an investment related item, that profit is non-operational. So you don't want it. What did profit do to profit before tax? It increased profit before tax. You don't want it in there. So to remove it, we must subtract it. So we'll say less profit on sale of investment. We may have made interest income. So you also want to say less interest on investment. So you get the gist of it now. Okay, so you get the gist of it. So what you want to just take note of is the following, that you want to ask yourself, including that profit before tax number, what is a non-cash flow item and what is a non-operational item? Okay, so if it's any item, if it's a cost or an income that relates to a financing decision, or if it's a cost or an income that relates to an investment decision, we don't want it. We only want operational cash flow. And if it's a non-cash flow, you must also remove it. Okay, then you can have you might just have a look at various setups, whatever makes easier, but then you could have cash flow before tax, and you can just have tax, okay? Or you can have a separate tax calculation. Okay, so just take notes. You might just have a look how to get the tax number, what is easier for you to get the tax number. There are different ways to get the tax number. Generally, this may be an easier way. I don't know, okay? Then we have two more items you want to include. You want to just have change in working capital and okay, um, capital expenditure. Okay, so these over here is basically relating to operational costs, okay, like salaries, wages, rates, water, electricity, and all of those type of stuff in order to run the business, cost of sales, all of those kind of stuff. So this here is the costs incurred to run the business, okay, that number over there. Then you have tax. Change in working capital. In order to operate, you need working capital. Think about Pick and Pay. Think about ShopRite. Without inventory, they can't make money. So in order to have a successful operations, they need inventory. Inventory is considered working capital. You think about Woolworths, Truworths, Foschini. Most of their sales are done on credit. Like I think Foschini and Truworths, like 90 to 95% of their sales is credit sales. So without debtors, they won't be able to have they won't be able to make money. So therefore, debtors is working capital. It's operational. So therefore, we include it in the operational number. What's important, we're not using the working capital balance. We're using the change in working capital. This is another area where someone can make an error and you need to pick that up. Tax is another area where someone can make an error and you need to pick it up. This over here, they may omit it or they may have the incorrect direction. They may omit it or they may have the incorrect direction. For the interest on debt, they may include the full interest number, but you must only maybe include one interest number. Maybe this interest is interest on debt as well as interest on bank overdraft. We don't want interest on bank overdraft because bank overdraft is typically operational. So if the bank overdraft is operational, then the interest on bank overdraft is an operational cost. So you're okay with it. So they may include the full debt number, but then you should only, but what should be done is only include the financing debt. The depreciation or the other items may be omitted or may be in the incorrect direction. Tax may be calculated incorrectly because they may have not adjusted for these items correctly to get to the correct tax number. Working capital, we don't want the balance in working capital, we want the change in working capital. Similarly over here, did they work out the capital expenditure correctly? So let's show you how it worked out those numbers. Okay, so I'm going to work out change in working capital, and I'll work out um, um, capex. Okay, so change in working capital. Okay, so change in working capital would look as follows. You will list the various types of working capital. So you must see how the question provided, but typically on a detailed level, it will look as follows. Debtors, inventory, debtors, cash. There could be anything else as well, and then creditors. Okay, these are the typical ones. Okay, so let's just assume, what was it, years we had? I use years. Okay, I'm just going to use this years. Okay. Okay, let's just do it like that. Okay. So then you will have numbers over here. So this here is balance. Okay, so that there is the balance. That's very important. Just take note, you will only include cash if they tell you cash is operational. So typically you'll have a cash balance, and they'll tell you 3% or 5% of the cash balance is used for operations. If they don't tell you that, you assume cash is non-operational. The only time you put in cash over there as a working capital, if they tell you 5% of the cash balance is for operations. So if the cash balance is 100,000, you take 5%, it'll be 5,000 Rand. Okay, so just take note of that. So, but if they don't tell you anything regarding cash as operational, then you assume cash is non-operational. Very important. Okay, then you have the balance. Okay, so here you have the balance now. But you don't want the balance, you want change in working capital. The way you're going to get change in working capital is by saying you will subtract the two, that minus that, that minus that, that minus that. So for example, let's just make up a number, 10,000, 11,000, 13,000, 14,000. Okay, so the change would be last year minus this year. Okay, last year minus this year. Okay, and so forth. Okay, so as you can see, the numbers are so because the numbers are increasing, we want this to be negative. Because working capital is increasing, it means we need more financing. So with the more financing we need, the more outflow is required. Okay, so the if working capital is increasing year on year, it must be a negative, which it means we need more cash flow to fund those working capital. If working capital is decreasing, we will expect the change to be positive. So what would happen? That change will come in over here. Okay, so that change would come in over there. Okay, so just take note of that. So that change will come in over there. We don't put in 11, 13, 14. We put in 1, 2, 1. Okay, just take note of that. Similarly, with capital expenditure, Okay. Okay, with capital expenditure, we have the same thing over there. So all we have to do is, if we use the T account, if we use a T account, okay, so this is basically a PPE account, PPE. So we have opening balance, we have closing balance, we would have disposals, we would have depreciation, and then we will have purchases. Okay. So all what we are doing is doing the following. We're just rearranging this thing over here. So this is going to be as follows. It will be opening balance less closing balance less depreciation. And that would give us capex, purchases. This will give us net purchases, capex. So here you can see opening balance, closing balance, closing balance, depreciation, depreciation. Then we get net purchase. Net purchases is purchases minus disposals. Okay, that is our capex. So whatever number we get over here, opening balance 10,000, depreciation negative 1,000, closing balance I don't know, negative 15,000. So if we add this up, we had a capex expenditure of 6,000 Rand. Okay, whatever it is, take that number and we go and plug it in over here. Okay, so that's basically what happens. And then we sum this up. So we expect this will typically be negative. Doesn't have to be negative. Doesn't have to be negative. Just take note. It doesn't have to be negative, but it typically be negative. We expect capital expenditure to be an outflow. Okay, and then we will get cash flow from operations. Okay, then what will happen? We will add terminal value. We'll have terminal value, and with the terminal value, this will give you basically free cash flow. Okay, so it will give us free cash flow. Remember, the terminal value is taken from there onwards. The terminal value captures the value from after the explicit period. Now, the terminal value will bring the value at the beginning of year 4. So the year 4 is when the terminal value starts. Why? Because year 3 is when the explicit period ends. So year 4 is when the terminal value starts up until the end of time. because year 3 is when the explicit period ends. Now the value of the terminal value will bring a value at the beginning of year 4. So the value always brings a value at the beginning of the period. Okay. But we know each column represents the end of a period. So we can't show the value in year 4 because year 4 represents the end of year 4. The terminal value is bringing the value at the beginning of year 4. So where can we show the beginning? We show it. The end of year 3 is the same as the beginning of year 4. And so the terminal value will go in over there. Similarly, over here, when we get the free cash flow, we're going to show the value in year 0. Why do we show it in year 0? Because the value is bringing the beginning of year 1. But we can't put it into year 1 because year 1 represents the end of year 1. So where is the beginning of year 1? The beginning of year 1 is year 0. Okay, so just take note of that. So there we have that what's happening over there. Okay. Now we need to work out the terminal value. Now we need to work out the terminal value. Okay. Now we need to work out the terminal value. The terminal value is similar to the dividend growth model. Okay, so the terminal value is similar to the dividend growth model. So the dividend growth model, so the way we'll calculate the terminal value is as follows. Terminal value equals cash flow year 3. Okay, so we use a cash flow of the previous period, and we grow it by the growth rate. Okay, and we grow it by the growth rate. What's important, the growth rate that you use needs to be the growth rate of the terminal period. So we're going to use the cash flow of the last explicit period. So we're going to use the cash flow of the last explicit period, which is year 3. And we're going to grow it by the growth rate of the terminal period, because we want cash flow of year 4. We want cash flow year 4. In order to get cash flow year 4, we take the last explicit period and we grow it by the growth rate of the terminal period. Okay, so the typical growth rate is going to be the growth rate that will be, they'll tell you the operations will grow at 5% for the foreseeable future. That is the sustainable growth rate. That is the growth rate of the continuing value or the terminal value. Okay, and then we're going to say divided by WACC minus the growth rate. Okay, so you must be able to see the similarities and the differences between this calculation and the dividend growth model. It's the exact same formula. The dividend growth model looks like this. D naught 1 plus the growth rate divided by KE minus G. So there you can see we're using a cash flow number, and we're using also a cash flow number. In this case, the cash flow number is dividends. Why? Because we are using the dividend growth model. So the cash flow is dividends. Over here, we are valuing the business, the operations. So we're using the operational cash flow number. Over there, we're using the dividend cash flow number. In both cases, we're growing by the growth rate. Over here, we're growing by a sustainable growth rate for the cash flow. Over here, we are growing by a sustainable growth rate of the dividends. Then we have the denominator. The discount rate for a business is WACC. The discount rate for dividends is the cost of equity. And then we're using the same growth rate. In this year, that growth rate and that growth rate is the same. Over here, that growth rate and that growth rate is the same. So see the similarities, see the differences. Okay, so you will just use that to get the number. So we'll use cash flow 3. So basically we'll just say cash flow 3. We will have G and we will have WACC, and then that will give us the terminal value. then you use the formula to get the terminal value. And you go plug the terminal value over, where would we plug it? We plug the terminal value over here, okay? And that will give us the free cash flow. But this is going to give us future cash flows. We don't want future cash flows. We want the cash flows today. So to get the cash flows today, we're going to discount it. Discount, and the discount rate is WACC. Once we discount it, we will get free cash flow from operations. So once we discount it, we will get free cash flow from operations. So this number over here is bringing us the value at the beginning of year one. But we can't put it into year one because year one represents the end of year one. So where is the beginning of year one? Year zero. So that's the free cash flow. Once again, for the terminal value, I just want to bring your attention if you want to identify errors. If you want to identify errors, there will be lots of errors in the terminal value. So you must have a look. Are they using the correct cash flow number? Are they using the correct growth rate? And are they using WACC? And they're not using another discount rate. The other thing you want to identify, where do they plug in the terminal value? They will sometimes plug the terminal value in over there. But the terminal value needs to be in at the end of the explicit period. And then you need to discount it to year zero. So just take note, okay? Now, if you have a look, I'm going to just do the following. Assets equals equity plus liabilities. Remember, we want the value of equity. So assets minus liabilities equal equity. I can split that up. Assets is non-current assets plus current assets minus non-current liabilities plus current liabilities equal equity. Okay, this number over here, free cash flows, took into account current assets. Current assets is your working capital. Okay, current assets, your debtors, your operational assets, your debtors, your creditors, your debtors, inventory, and so forth. Okay. It also took into current liabilities, which is your creditors. Okay. You might just take note if there's short-term debt and stuff like that, it won't be that. Okay. Capital expenditure, it took in certain non-current assets. It took in operational non-current assets, PPE, intangible assets, and so forth. So, for example, a manufacturing company would have PPE. A pharmaceutical would have PPE and intangible assets, their patents, and so forth. Okay. So we have captured almost all current assets, if not all. We have captured all current liabilities. We have captured some non-current assets, and we have captured nothing of non-current liabilities. So we have already captured current assets. We have already captured current liabilities. We have captured some non-current assets. So we must add certain non-current assets. So here we're going to say add non-operational assets. So typical non-operational assets would be cash. So remember I told you in this cash calculation, you will only have cash over there if they tell you a certain percentage of the cash balance is operational. So let's say 5%. So then that means the cash number you put in over here will be 95%. If they don't say anything regarding the cash number as operational, then 100% of the cash will be 100% of the cash will be non-operational. Okay, then you can have other non-operational assets like investments. Okay, so you can have other non-operational assets like investments. So PPE, leased assets, intangibles, that those are typically operational. You have to have a look at it within the context of the business. Typical non-operational assets is like your investments in shares, investment in subsidiaries, investments in associates, and so forth. Okay, then that will give us, now that we have captured all operations and we have captured the remaining of the assets, this will give us value of the business. We don't want value of the business, we want value of equity. So all we have to do to get to the value of business, because the value of business now have captured all non-current assets, have captured all current assets, and have captured all current liabilities. So all we have to do is say less, non-operational debt. So that's your non-current debt. So this would be long-term loan, debentures, bonds, etc. Okay. Then they may just have a look. They can also include over here preference shares. Okay, so we don't want preference shares because we're valuing ordinary equity. Okay, we don't want preference shares because we are valuing ordinary equity. Cash will always be the cash balance. The investments, we have to apply valuation methods like you do in WACC, like preference shares and so forth. You have to use those kind of methods. Same with over here, like you would value long-term debt, debentures, bonds, preference shares as you do in the WACC calculation. You'll do the same. You don't take the balance per the balance sheet because that's a carrying amount. You need to take the market value. And then we would have that will give us value of equity. Just take note over here. If I have in what we call this, if I have this italics, you don't have to include it. The italics is just there for a note for yourself. Okay, that will be value of equity, 100%. Okay, we will have the same adjustments as we have over here. We won't have a marketability adjustment because we're not valuing a private company, but we will have that over there. Okay, so we will have this over here. Because we're acquiring a majority interest, we will have that. So once again, if you want the value per ordinary share, you say divided by number of shares to get the value of equity per share. If you want 70%, 80%, you take that, multiply by 80%. So that is why a free cash flow can run between 15 to 30 marks. You can see all the details. A complex valuation, free cash flow, all of this is complex. Tax is complex. The terminal value is always going to be a challenger one. And then they want you to value all of these items over here. An easy one is either this is complex, then everything else is easy, or this is easy, then they complicate that and they make this easy, or they make all of this easy and then they complicate this over here. So an easy one is where like I divided into 3 parts. I divided into basically 3 to 4 parts. This calculation over there, tax, the terminal value, and then this over there, right? So they can either make this easy, complicate tax and make all of that easy. They can make this whole thing complicated, meaning when I say complicated, it means you must calculate every single number, and every single number or most of the numbers require you to think. So, but basically, this is how a valuation, a free cash flow valuation would look like. Keep the format. I mean, the format is not cast in stone, because there can be other things that could change the format slightly here and there, but this is the general approach to a free cash flow calculation. Remember, here we got to the value of operation, which was current assets, current liabilities, and certain non-current assets. Then we added non-operational assets, and that gave us the value of the business. So that accounted for all of that plus that. And then we need, in order to get to equity, we needed to take into account non-current liabilities, which is basically largely your non-operational debt, like your long-term debt. But now remember, we don't want total equity. We want only ordinary equity. So if total equity includes preference shares, you must make sure you remove preference shares as well, because you only want the value of ordinary equity. So this preference shares could be debt or equity. Sometimes preference shares is under debt, sometimes preference shares is under equity. You want to remove all preference shares because you want to end up with ordinary equity. Just take note of that. Okay, so then we get value of equity before majority premium. You add the majority premium, and then you have value of equity, 100%. If you want value of equity per share, you just say number of shares in issue, and then you say value of equity 100% divided by number of shares, and that will give you value per share. If you want let's say you only want your percentage you want to acquire, so if you're acquiring 70%, you just simply say 100% times 70%, and then it gives you your portion. So this over here I'm going to highlight in yellow or orange because it's not always going to be applicable. Okay. So that is the free cash flow model, and I covered the PE multiple. Is there any questions on your side? Any questions? Yes, no? Kennedy, Keo, Ryan, Sandisiwe.
All good, Faiz.
No question.
You have a question? No, yes, no.
No.
Oh. Okay, so now we can switch over into the question. Oh, I need to go find it, but I lost it now. Let's go find that question quickly.